The day risk became a currency. It did not begin with disaster or even with fear. It began with calculation. A quiet realization spreading through London's financial circles that uncertainty itself could be measured, priced, and traded. What had once been an invisible shadow behind every deal was about to become a product, and that shift would change finance forever. London was no stranger to danger. Ships vanished. Markets turned. Wars rewrote fortunes overnight. For generations, risk was treated as fate, an unavoidable companion to ambition. Merchants accepted losses as the cost of reaching further than their rivals. But as the city's financial machinery grew more complex, this old acceptance began to feel inefficient, too blunt, too wasteful. To understand why this moment mattered, we must step into a London where capital was moving faster than certainty. Trade spanned oceans. Investments tied together strangers who would never meet. One failure could ripple through dozens of accounts. The old methods, trust, instinct, experience, were no longer enough. The city needed a way to manage uncertainty without slowing growth. The reveal came quietly, in coffee houses and counting rooms where merchants compared outcomes instead of stories. They began noticing patterns. Certain routes failed more often. Certain ventures carried predictable dangers. Losses once thought random showed rhythm. And where rhythm exists, pricing becomes possible. Slowly, almost cautiously, new arrangements appeared. Agreements that transferred risk from one party to another. Promises that paid out only if disaster struck. Groups that pooled exposure, so no single failure proved fatal. These ideas felt radical, even unsettling. They suggested that danger itself could be separated from action, bought, sold, and redistributed like any other commodity. What had once been fear was becoming a figure on a page. But beneath this innovation lay a profound shift. If risk could be priced, then those who understood it best could profit from uncertainty itself. And London was about to discover that turning danger into currency would create a new kind of power, one far less visible than gold, yet far more influential. As the idea took hold, London's financial world began to reorganize around it. Risk was no longer something to endure at the edges of commerce. It moved toward the center. Merchants started asking not whether danger existed, but who should carry it. And once that question was asked, a market began to form almost inevitably. Early transactions were cautious. A shipowner might agree to pay a small premium, so another party would absorb a loss if the voyage failed. A merchant might accept a lower return in exchange for certainty. These arrangements felt practical, even reassuring. They allowed business to continue without forcing every participant to gamble everything on a single outcome. Uncertainty was being redistributed, diluted across many hands. But with every agreement, a deeper transformation unfolded. People realized that risk behaved differently from goods or money. It multiplied when misunderstood. It shrank when studied. Those who learned to measure it, who tracked losses, routes, timing, and exposure, gained an advantage no warehouse or fleet could match. Knowledge itself became leverage. This new logic attracted a different kind of participant. Some entered trade without ever touching cargo. They studied probabilities instead of prices. They positioned themselves not where goods moved, but where uncertainty concentrated. Their profits did not depend on success, but on balance, on ensuring that gains from calm outweighed losses from disaster. To many traditional merchants, this felt unnatural, even predatory. Tension grew as these specialists prospered. When voyages succeeded, they collected steady premiums. When disaster struck, they paid out, but often survived because their risks were spread thin. Merchants began to notice something unsettling. Those trading in risk sometimes earned more from failure than others earned from success. The city's relationship with danger was changing. Debates erupted across coffee houses and docks. Was it ethical to profit from catastrophe? Did pricing risk encourage recklessness or restrain it? Some argued that protection made traders bolder, pushing them into ventures they would otherwise avoid. Others claimed the opposite, that clear pricing forced realism, exposing hazards that optimism once ignored. As arguments sharpened, institutions quietly adapted. Contract became more complex. Clauses multiplied. Entire agreements were structured around contingencies rather than outcomes. London's financial language evolved, absorbing uncertainty into its grammar. Risk was no longer an afterthought. It was a line item. Yet, beneath the sophistication lay fragility. The system assumed that risk could always be calculated accurately, that losses would remain within expected bounds, that models built on the past could withstand the future. Few stopped to ask what would happen if the patterns broke. And as confidence in this new currency grew, London edged closer to a moment when uncertainty would test the very system designed to tame it. The system began to strain when reality refused to follow expectation. Patterns that once felt reliable started to blur as trade expanded into unfamiliar territories and political tensions reshaped entire regions overnight. Routes considered safe turned volatile. Ventures once predictable spiraled into chaos. And the models built to price risk struggled to keep pace with a world moving faster than calculation. The first cracks appeared quietly. A cluster of losses exceeded what premiums had been designed to absorb. Payments were delayed. Reserves thinned. Those who specialized in risk reassured the market, insisting these were temporary distortions. But merchants noticed something troubling. The same instruments that promised protection were now amplifying anxiety. Confidence wavered not because danger increased, but because no one knew who truly held it. As uncertainty deepened, risk traders tightened terms. Premiums rose sharply. Coverage narrowed. Agreements that once offered broad protection now came with exclusions and conditions buried in dense language. Merchants felt cornered. To operate, they needed protection. To afford protection, they needed success. And success was becoming harder to secure under mounting costs. The conflict sharpened when rumors spread that some risk holders could not meet their obligations if disasters continued. Whispers moved faster than facts. Trust evaporated. Merchants rushed to secure guarantees, overwhelming the very institutions designed to provide them. What had been a market for distributing uncertainty became a mirror reflecting collective fear. Traditional traders accused risk specialists of engineering fragility, of building a system that thrived on calm but collapsed under stress. Specialists countered that merchants had grown reckless, relying too heavily on protection instead of caution. Each side blamed the other, even as the system tying them together tightened like a knot. The tension reached a breaking point when a major shock struck without warning. A combination of failed ventures, political disruption, and environmental loss hit multiple sectors at once. Losses arrived simultaneously rather than sequentially. The assumptions underpinning diversification collapsed. Risk, once neatly spread, converged. Payments stalled. Contracts were contested. Some institutions froze activity to survive. Others failed outright. The city watched in disbelief as a currency built to control uncertainty became its accelerant. Danger had not vanished. It had concentrated. London was forced to confront a hard truth. Turning risk into currency had unlocked growth, but it also created invisible dependencies no one fully understood. The system worked beautifully, until it didn't. And as the shock wave spread through the city, the question became unavoidable. Could risk ever truly be controlled once it was given a price? The collapse did not arrive as a single event. It unfolded in layers, revealing just how deeply risk had woven itself into London's financial bloodstream. As institutions struggled to meet obligations, the city realized that uncertainty had been traded so many times that no one could say where it truly rested. What was meant to absorb shock had instead transmitted it. In the aftermath, anger gave way to reflection. Merchants saw how protection had encouraged expansion without restraint. Risk traders recognized how models built on yesterday's data failed against tomorrow's realities. Officials understood that a market powerful enough to price uncertainty was powerful enough to destabilize the entire system if left unchecked. Out of this reckoning came change. New limits were imposed on exposure. Reserves were strengthened. Transparency became a demand rather than a courtesy. Risk did not disappear, but it was anchored. The city learned that uncertainty could be managed, but never eliminated, never fully mastered, and never safely ignored. London emerged wiser. It continued to price risk, but with humility earned through failure. The lesson endured quietly across centuries of finance. when danger becomes a currency. It grants immense power to those who understand it, but it punishes those who believe it obeys simple rules. Sometimes the smallest shift in perspective becomes the beginning of a new future. The day